Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. And what is velocity banking? Well, basically, all it is a debt payoff strategy where you throw all of your money into debt with the help of something called the line of credit. And we're going to solve the number one rich person or rich people problems, which is a savings account, right? So, did you know that one of the main differences between the poor person and rich person's mentality, and I'm not talking about how much money they necessarily have, but their mentality is that rich people think savings accounts are bad and poor people think savings accounts are good. Okay. And so if you take a look here, the average American and velocity banking, one of the main differences is that here you have $1 savings and here you have zero. So if you ask the average person, hey, like, what do you think is better? $1 of savings or zero? And most people say, well, of course, saving money is better than not saving money, right? Saving money is better than not saving money. So if you take a look at my bank statement right here, I don't have any money saved. Money comes in and it goes out. And we're going to do this thing called velocity banking, where it's actually going to go into a line of credit. And then this number called cash flow is actually going to multiply. it's a it's going to multiply by 2000 and something because I've done the math before, simply by moving some debt into a line of credit, right? And so, in order to complete your budget, you got to do an expense breakdown. And this is a debt payoff strategy. So, you have to list every single debt that you have, every single debt, four credit cards, an auto loan, student loan, and a mortgage. And then we have our food, gas, insurance. So, these are our general non debt expenses that we have right here. We'll say $2,000 a month. Okay. And then, so what we're going to do is we're going to move some debt into the line of credit, and I'm just going to do this right here. So let's go ahead and do this. Move some debt into the line of credit. So 5, 15, 27, 30. How much is the credit cards is that? That's 77,000. 77,000. And we're going to assume we have an $80,000 line of credit available to us at 8%, right? Now, when we do a balance transfer, essentially, of that 77,000, guess what happens to these payments? Zero, 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 right? So even though we didn't save money, like look at this, no money saved, we somehow multiplied this $1 to $2,568.50. How did I do it? How do we do it? I don't know. Same income, right? Same list of expenses, but by simply shuffling the debt, we made this $1 to 2000, more than $2,000, right? More than $2,000. And again, most people, because they can't see the forest for the trees, when they see the $0 in the savings account, they're like freaking out. Oh my goodness, like $0, right? And then the last step is that we're going to put our paycheck, this entire $6,300, into the line of credit. So let me just kind of show you right here. $6,000 goes here, or $6,334 goes here. You take your expenses out, and then you rinse and repeat after 2000, or rinse and repeat. And then after every single month, the balance of the line of credit will go down by 2,500 and some change. Okay. So I kind of skipped steps here just because I was so excited to show the like $1 to $2,568 part. But let me actually go a little bit backwards and first explain, this thing called the line of credit. So, what's a line of credit? All it is a financial tool where you could borrow money, pay back, and then use it over and over again. That's all a line of credit is. So, if you take a look here, so let me just go here, you can see that I have a $280,000 home equity line of credit. $280,000. So what does that mean? I can literally go into the bank's website or app, and then I click a button, and then they'll dump up to $280,000 into my checking account at a 7.5% interest rate. 7.5% interest rate. Okay. So isn't that pretty cool? Yeah, that's pretty cool, right? Like, whoa, I didn't know these debt products existed. And so basically, unlike even better than a credit card because like you can use it to pay anything you want, right? You can use it to pay anything you want, $280,000. So I have over how much do I have? $594,000 in lines of credit. And I'm going to tell you the secret to getting all these lines of credit is that banks don't lend money to people who need it. And this kind of confusing to people, because if you look at bank marketing and bank advertising, what do they always say? They always say stuff like, "Oh my goodness, we'll be there for you when you need us," and then they don't lend to you if you need them, right? That's the secret. Banks don't lend money to people who need it. And if you understand that secret, you'll be able to easily get lines of credit like I have, 594,000. And I know it'll piss some of you off, but some people say, well, you got to be realistic, but you know what realistic is? Most people only have $6,000 of credit card debt, and we're dealing with 77,000. And 90% of the people can't even qualify for a mortgage. So, realistic means you're not even going to get any debt because banks don't lend money to people who need it, right? Okay. So, all right. So let's go ahead and do this and get the next month's balance, just based on the previous month's balance plus the previous month's interest minus our cash flow. So, what's our cash flow? Let's go back here. It's 2568.5. And then what we're going to do is take the average daily balance, multiply by the interest rate times 0.08, and then divide by 12. And then I'm going to do this, and we're going to copy and paste, and you see paycheck in, expenses out, paycheck in, expenses out. Whoa! We literally started off with $1 of savings, and now like this debt is actually going down. Crazy, right? All right. So let's go ahead, and we see that in 34 months. Whoa, it was so paid off. In fact, I gotta find a clip of Bill and Ted where they go, "Whoa, man, Keanu has changed over the years." I'm just kidding. Actually, Bill and Ted 3, I watched, I was like, this is dumb. This is dumb. They should have never, like, they need to stop remaking movies from the 80s. I saw the teaser trailer for the Naked Gun to 2025, I think. I was like, really? Are they really remaking this again? But the last part of the trailer was kind of funny. I admit that. But everything else is like, I can't believe they're remaking the Naked Gun. Oh my goodness. All right. So 77K, 34 months, right? 34 months. And then we're gonna go ahead and do this. And let's go ahead. Now we got these 3 loans, right? So let's go ahead here. And I am going to do this. So luckily we have this loan calculator right here. So what we do is we put the current month of the loans, or all the loans right now, and then you could see a snapshot of where you are with these loans. And so if you type in 34 right here, okay, you see that's $9,000. So we have this thing called the cash flow index, and all it is a formula of the balance divided by the payment, and then it gives you a number, right? So we kind of think of this as like a ranking system, and the lower the number, that's the one you want to pay off. The lower the number, okay? So what does the low number mean? It means if I pay off 9 grand, I get $386 back in my cash flow. Whereas I don't want to pay the higher number, because if I pay off 189 grand, I only get $954 in my cash flow. So this one gives me more bang for my buck. So a lot of people say, oh, focus on the interest rate, right? Let's not do that. Let's focus on the cash flow. Just be a much easier experience for a debt payoff. And then I'm going to go ahead and move that right here. And then this is going to be plus 9616.67. Okay. And then let's go ahead and then do 0. And then I'm going to do this. And I am going to do this. All right. So 2955.25. All right. So now let's go ahead and do this right here. So 37 months, right? So let me just kind of go here, 77 plus 21, and then 98K, and then 37 months, right? And then, okay, and then let me just do this right here. So just do 37, 37. This is now 0. I'm okay with. So just kind of a certain dynamic you have to understand about loans. So if you have a loan, right, the interest rate does matter. So the more of a difference between your loan and line of credit, and the higher this number is, right, it's going to affect the amount of interest that gets paid, because you might be possibly overpaying if you move a loan into line of credit. Now, in my opinion, you really have to only really care about this with the 30-year mortgage because this number will be big in the 30-year mortgage, and this number is usually small, right? Like number is usually small, and so a big mistake, and I would actually consider this to be the number one velocity banking mistake, is to move the entire loan into a line of credit, right? Or the entire 30-year mortgage into a line of credit. All right, let me just go ahead and move the student loan. So I'm going to do this right here. And then I am going to do this. And then this is going to be plus 29718.13. All right. And then I'm going to do this right here. This is 0. So we have extra $426 in our cash flow. And look at that. Our cash flow is above $3,000 now. That was so easy. Oh my goodness. All right. See, that's like the slogan of this channel. Look how easy it is, right? It's kind of like one of those infomercials. You know who the OG infomercial dude is? It's that guy who went to prison for visiting hookers. The ShamWow, was it ShamWow? Or is it the Chop guy? Or what, were they the same guy? His name was Vince Offer, I believe. Vince Offer. Yeah, it's this guy, right? Yeah, this guy. Oh, dang. He's doing pretty good for himself. And this was, I think, dang. Actually, what's going on with him? 60 years old. Where hold on. Hold on. Went to jail. Oh yeah. Wow. 2009. Okay. Miami Beach. I've never been there, but no judgment here. I was just curious. Oh wow. It's cleans up his act. But anyways, my point is is that I kind of got ooh, that's not good. Anyways, I kind of got inspired by this ShamWow guy where he's like, he's really good when he shows the products where he just like does the chop and the ShamWow and is like, dang, like love the dude, right? Except when he's not committing crimes. All right, so let's go ahead and get started, or not get started. Go back to here. All right, so now this is gonna be right here, and then 46 months. All right, so now 46 months. All right, and then this is gonna be 98 plus 40, and then this is gonna be 138K. 138K. And then now let's in 46 months go to the 30-year mortgage, 30-year, actually this one is going to be 0. And then 30-year mortgage, and we see that the 30-year mortgage is at 185 grand. We've paid a good amount of interest so far, 30 grand. But here's the most important thing when it comes to a 30-year mortgage. Pay it last, okay? Because why? You borrowed 185 grand and you're only paying 954, so get the other cash flow first and then use the other cash flow to pay off the mortgage, right? And here's the thing, a lot of people act like, oh, extra payments or line of credit. Like when you use a line of credit, technically it's an extra payment, right? And one of the reasons why you might just use a line of credit to still pay it instead of just directly overpaying is because you don't want to, quote, segregate your income, right? So one of the reasons why so many people, and I talked to a gentleman like a couple months ago where he knew how a mortgage works. He's like, oh yeah, like I have a $400,000 mortgage and I'm sending an extra $100 of principal. And I asked him like, well, why not just dump your entire paycheck in there? Why not do it? And he was like, oh, well, I just, it's me being cautious and I like having savings. And again, you can dump your entire paycheck in there, use your line of credit as a backup, or just use your line of credit as to pay it off, and then just dump your entire paycheck into line of credit, right? Me, I prefer, this is just my preference, still using the line of credit because it makes my life easy to pay off the debt, right? So one of the things that really surprised me about this strategy is that even if I use like an 8% line of credit or a 9, 10, even a 15% line of credit, I can still pay it off quickly, even a 4% loan, right? So even though the interest rate does matter, and obviously you want the lowest interest rate in the loan or the line of credit, right? You could still pay it off relatively quickly with the higher interest rate line of credit. So let me go ahead and pull out the Velocity Banking Calculator. All right, here we go. We got the Velocity Banking calculator ready. Put in all the numbers, and you see right here 3.9 years and 15 grand of interest. That's pretty sweet, right? Even though it's a $7,000 chunk at 8%. So even though we're using an 8% line of credit, not a big deal. Listen, we could do a 15% and look how much it goes up, just 1 grand. If we do 30%, oh, oh, just the 3 extra grand, right? So this is why, like, even if I use a 30% credit card, I really wouldn't mind it because think about it from the credit card issuer's point of view. Let's say you're doing $7,000 chunks, they'd raise your credit limit immediately, right? They're like, whoa, this person's doing like $7,000 purchases, right? And so sometimes, even if you pay a little bit more, there's a saying, the best credit decision is not the best financial decision, right? You want to go from, let's say, 7 grand in credit limits to 30 grand. Think about what would happen if you do $7,000 chunks. Crazy, right? So let me go ahead and go back to 8. And one thing I do want to mention is if you move your loan into the line of credit, look at that. Look at you pay double the interest. You don't want to do that, right? So 3.9 years, and then look at that. That's so beautiful. That's so beautiful. All right. So now to do this. So 46 divided by 12 plus 3.9. This is going to be 7.73 years. 3 years. We are debt free. We are debt free. Okay. And then now this is 0. And that was the goal. That was the goal, to not save money, because remember in the beginning, we were taking a look at this and we went from $1 to 0, like 1 to 0. Most people would freak out here, right? Most people would freak out here. They're comfortable with the $1, kind of like The Price is Right. Actually, I don't. Every time someone bid a dollar, I never knew why they did it. But all right, so let's go take a look here. And $0. This is like, if I have more money in my savings account, it's not like a payday for a loan or a credit card. I'm a little worried. Okay. All right, let's just say that. And I probably know you have your eye around here. Subliminal messaging. Okay, well, that's it for today, folks. This is Korean Atlanta Mentorship. Have a great day, and I'll see you all in the next video.